So what happens when an economy hits a rough patch? Say it's slowing down or maybe it's overheating with inflation. How do policymakers actually step in and try to steer the ship? Well, they have two main toolkits they can reach for, and today we're going to break them both down: monetary and fiscal policy. We'll look at who uses them, what they actually do, and how they work.
I mean, just think about that for a second. How do you actually steer a multi-trillion-dollar economy? It's this enormous, complex machine. You can't just flip a switch. It takes really careful, deliberate action, because making the wrong move could actually make things a whole lot worse.
And the answer lies right here in these two fundamental toolkits. You could almost think of them as the gas pedal and the brake for the economy. Each one works a little differently, and they're controlled by completely different groups of people. But at the end of the day, they're both aiming for the exact same goal: a stable, healthy economy.
All right, first up, let's dive into monetary policy. This is the toolkit that belongs to a nation's central bank. And what's really important here is that this institution operates with a crucial degree of independence from the day-to-day grind of politics.
So what is it exactly? Well, at its core, monetary policy is all about managing the amount of money and credit that's flowing through the economy. The central bank's goal is pretty straightforward: make it either easier or harder for people and businesses to borrow money. That directly influences how much we all spend and invest.
The who here is the central bank. In the US, that's the Federal Reserve, or the Fed. And their independence is absolutely key because it lets them make tough, sometimes unpopular decisions without worrying about elections. And what are their tools? The big one, the one you always hear about, is interest rates. That's basically the cost of borrowing money.
So this policy has two main settings: speed up or slow down. If the economy is sluggish and unemployment is a problem, the central bank goes expansionary. They lower interest rates. That makes it cheaper to get a loan for a car, a house, or a new factory, and the hope is that this encourages everyone to spend more. But on the flip side, if the economy is running too hot and inflation is creeping up, they switch gears to contractionary policy, raising rates to cool things down.
And what does this look like in our economic models? Well, when the central bank makes borrowing cheaper with expansionary policy, more people and more businesses take out loans and start spending. That increases the total demand for all goods and services across the economy. We show this as a rightward shift in the aggregate demand curve.
Okay, let's switch gears and look at the other toolkit: fiscal policy. This one is totally different. It is not controlled by the central bank. This is all in the hands of the government. So fiscal policy is really all about the government's own budget. It basically boils down to two huge levers they can pull: how much the government itself spends and how much it decides to collect from all of us in taxes.
Now, the who here is elected officials. In the US, that means Congress and the president. And that means all of these decisions are part of a political process, which, as you can imagine, can get pretty messy and take a lot longer. Their tools are very direct: government spending on things like infrastructure projects or defense, and of course, setting the tax rates for households and businesses.
And just like monetary policy, fiscal policy has those same two gears. To fight a recession, the government can use expansionary policy. It can either spend more money directly, building roads and bridges, or it can cut taxes, leaving more money in our pockets to hopefully go out and spend. And to fight inflation, they do the opposite. They can cut spending or raise taxes to try and reduce that overall demand.
And hey, look at that. The effect on our model is the same. Whether it's the government spending $1 billion on a new project, or households spending the money they saved from a tax cut, the total demand for goods and services in the economy goes up. And once again, that shifts the aggregate demand curve to the right.
Okay, so we've looked at both toolkits. They have pretty similar goals, speeding up or slowing down the economy, but their methods are totally different. So now let's put them side by side for a real head-to-head comparison.
This table really lays out the big differences. You've got monetary policy run by an independent central bank, which keeps it out of the political fray. And then you have fiscal policy, which is inherently political. The tools are different: interest rates versus spending and taxes. But here are two really crucial distinctions: speed and impact. Monetary policy can be implemented fast. A central bank committee can literally change interest rates in a single meeting. Fiscal policy, on the other hand, has to go through a long, drawn-out political process, and the impact is different too. Monetary policy is a blunt instrument. It affects the entire economy more or less evenly. But fiscal policy can be very targeted. You could pass a law that gives a tax break just to one specific industry, for example.
So why does any of this actually matter to you? Well, because these decisions directly affect your life. They influence everything from the interest rate on your mortgage or your car loan to the taxes taken out of your paycheck, and of course the overall health of the job market.
So let's sum it all up. We have two powerful toolkits. They both aim to stabilize the economy, usually by fighting either a recession or inflation. And they both work by influencing total spending, what we call aggregate demand. The really critical differences are who gets to act, what tools they use, and how fast they can do it. That's what makes this whole subject so complex and so fascinating.
You know, in the end, it all comes down to this idea. Policymakers are basically trying to be like Goldilocks. They don't want an economy that's running too hot with runaway inflation, and they don't want one that's too cold with high unemployment. They're always searching for that just right balance that leads to stable, sustainable growth.
And that really brings us to our final big picture question. In today's world, with global supply chains, brand new digital currencies, and all sorts of unexpected shocks, are these two classic toolkits still enough to get the job done? Or are we going to need a whole new set of tools for the challenges of the 21st century? That's something for all of us to think about.